Deborah Borchardt, and this is your midday market update. Well, stocks are down for now, but they look like they could be recovering. Nasdaq's down, S&P 500 is up, and the Dow is still down. But like I said, it does look like we're starting to trim those losses a little bit. The top headlines today, well, Merck missed. Stock is down as a result of that on its earnings, getting hurt by generics. Biogen doing very well with its MS drug, and then the pending home sales came in kind of a disappointment, down 5.6%, which really started our selling. But what we're going to talk about now is consumer staples. I'm joined by Mark Newton. So Mark, last week you and I talked about utilities and how they were starting to really come back. You were also saying, you know, that consumer staples are also looking a whole lot better as well.
You're definitely starting to see a lot of these defensive sectors firm up for the first time in a while. And so that's interesting given the fact that the market's been higher, really no sign of any deterioration, and yet all of a sudden you're seeing strength in the staples and telecom, and there was some M&A activity there, and utilities. And so consumer staples today, top performing sector, it's up nearly 1% while the market by and large is stalled out.
Now, when Mark talks about consumer staples, if you're not aware, he's talking about names like Hershey, Kraft, you know, McCormick, those kinds of things that are really familiar to us all. Now, a lot of traders think that there's going to perhaps be a correction in the next 2 or 3 weeks. Could this be a precursor to that?
It typically can serve as a warning sign when you see real strength in the defensive sectors, along with some of the other groups that have led the market rally starting to peter out. And you've seen a bit of that in the last few weeks with financials dropping by the wayside. And some of that is due to simply the Justice Department suits that are going on, which has been plaguing that sector really for the last few months and probably will continue to. It's very reminiscent of IBM back in the 70s when it faced a lot of the antitrust regulations. So yeah, the financials seems to be a sector that's fallen out of favor. You're seeing a little bit of weakness in energy just because of crude oil having pulled back as much as it has. There's a weakness in the energy commodities. But, you know, the defensives are definitely a group to look at, particularly as you reach the month of November. You start to see a bottoming out and a lot of the mean reversion that plays out in the market where some of the worst performing groups all of a sudden start to show strength. And some stocks like Kellogg and Philip Morris that haven't really shown the move to new highs like a lot of these groups, I think potentially could be a better risk reward technically for the next few weeks.
All right, well, there you have it. If you are wondering what to do as you're looking for some names to buy, and of course, also any ETFs that cover this index, check those names out. That's Mark Newton from Greywolf, and I'm Deborah Borchardt with The Street.